Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we're going to go through the EIA data and just what does it mean. You know, the API numbers seemed a bit off, but we'll kind of go through what does that mean, what do we think, and we're going to break it into our normal 3 shows of overview, refined products, going deeper into the demand side, and then looking at exports and what's happening on the global market. So before we get kick this off, again, please like, share, subscribe. You know, your support is appreciated. Your questions are always welcome, and we love the commentary. So just kicking it off here, you can see that the crude stock actually had a build. So it was a crude stock build of about 4.28 million, and that's on the whole commercial side. Then once we factor in the SPR, the build was 3.71 million. And again, because we continue to have crude coming out of the Strategic Petroleum Reserve. The biggest build obviously was Pad 3. Again, we're still at the back end of the adjustments that were needed because of the hurricane. You can see that, you know, speaking of adjustments, there's always this there are a lot of numbers that we don't talk about, and just because this show is already long enough and we have to kind of cut down on and try to make sense of things, but there is this, let's call it a slush fund of where some of this oil can sit before it gets allocated. And here you can see the production is actually at 0 in terms of the change, and it's still at 10.5, even though it should already be back to about 11.1 million. And again, it's just going to be how it's classified, because we do have that Gulf of Mexico production that is back online. So there's going to be a little bit of a disconnect. So this will be adjusted for this week. But again, you can see that, you know, the crude stock is already starting to show where those builds came in as we had some of that backdrop coming for Pad 3. Now, Cushing had a small draw of about 520,000 barrels. We'll talk about why that's important, and then we're going to look at some of the different capacities in terms of imports and where some of the storage is sitting overall. Just giving you some context as to where the crude oil total inventory, again, this is including the SPR. So here you can see, again, like as we've been talking about, things are leveling off, and we're just maintaining this relatively high level as we go into hopefully an increase in total activity. But again, we're going to talk about what does that mean for refiners as we head through the remainder of the year. This is looking at Cushing. Here you can see we're continuing to hang around the that all-time high level. Again, it's just looking at where we were in April as some of the spreads continue to hinder a lot of this movement into not only the coast, but then into the international market. And we'll talk a little bit more about what does that mean for U.S. exports as we go to the end of the year. You know, again, we had that dip just because, again, we're looking at things going over the last, let's call it 30 years or so. So we're trying to understand, you know, what has happened over time. Oh, I'm sorry, not 30 years, because I was getting errors for some reason. So I went back to 2005. But you still get an idea, like they're adding those additional years, it would just be within this average, and the average would actually move up a little bit. But you can see that, you know, we still remain near highs, and the contracted side, as we talked about with some of the largest commercial owners of storage, remain fairly full. And the issues that are going to continue to arise is as lockdowns persist within Europe, and now the U.S. is starting to see a increased talk about additional lockdowns, not only on a city level but a state level. And we'll get through that in a bit more detail when we get to part 2. This is looking at crude oil inventory excluding the SPR. You can see we're still at seasonally adjusted all-time highs, you know, kind of hanging around the top of that, top of the range. This is something that is going to be persistent, just given where we see crude, you know, refinery throughput and how that crude is being moved through the system. And again, this is something that's going to be persistent, especially as we have, you know, pricing currently where it sits. Now, we've been talking about Pad 3 just because Pad 3 is where a lot of this crude should start to show up, especially when you have some of these increases that we've seen within the Permian and Texas in general coming down into the coast and trying to avoid Cushing, just because Pad 3 does have spare storage. It's not like we don't have storage in the U.S., It's just a matter of where is it going to show up, because right now you need to start avoiding Cushing a bit more just because things are getting a little tight. So you're going to start looking into pad 3. And then the question is, when you get to pad 3, can you get into a refiner? Can you get onto a boat and into the international markets? Or does it make sense to sit in storage and wait for a better time based on what the contango price is pricing in, and just looking at costs and then where prices are expected to be to try to create that arbitrage. So here you can see that we're bouncing again, remaining seasonally adjusted all-time highs above that level. Right now there's really nothing to say that we're going to get this big move back up, but at the same time we don't see anything that's going to tell us that we're going to get a big drawdown, especially as we get some of this normalization post-hurricane. The current hurricane right now, there was a lot of uncertainty in terms of where it was going to go. Initially, it kept moving further west in terms of what the projection was, which was going over Louisiana. It made and did a hard right and went east and went through the Panhandle. So that really avoided pretty much all of the production facilities in the offshore market. So that'll help protect some of the production numbers. But then when we start looking out, it really comes down to demand, because we did have a big pickup in demand for gasoline. But again, we have to look at the different points of shipping, because it's something where the demand side continues to weaken when we look at miles traveled and at the pump. But again, it's just a matter of how much do we have to backfill, how much do we have to move. And those are things that we're going to talk about in more detail in part 2. And here's where we start talking about imports. So obviously, pad 2 has been one that we've been talking about a lot, just because we see a decent amount of imports coming in additional from Canada. Pad 3 is still, again, a little bit of a makeup and nothing much, just because we had a lot of refiners that remain below utilization, or at least very low utilization. So there's not too much in terms of the import shift. But we will, talk a little bit more about that. And then obviously pad 5 is the one which is the West Coast, which again is all timing. As we said last week, we thought we were going to see a little bit of a spike, and it all comes down to when do things clear, when do ships show up. So this is something where we think we're going to get another increase in pad 3 in terms of imports. Pad 2 is going to remain fairly robust, just given kind of what we're seeing coming through the system. But again, it's going to matter in terms of where does a lot of the storage look, how do refined products, what are they showing, and what does that look like going forward. So when we start looking at refined products, again, the crack spreads continue to remain under pressure, even though they did have a good few days. They're starting to reverse, or continuing to reverse today. Again, they're getting better, but some of them are getting better along seasonal norms as things get a little bit tighter. But at the same time, they're still hanging below those 5-year averages and just at the bottoms of expectations. So that's why we're still not seeing too much activity, which, we expected to see a little bit of an increase in refinery utilization rates. Again, it's always going to come down to timing. Instead, we saw about 80 basis points come off. So instead of going from 75.3 up to about 76, we're at 74.5%. Again, we don't see all that much changing. We think that by the end of November, we'll start getting closer to that 80% number, and then maintain that 80% utilization rate as we go through the remainder of the year. But there's really nothing that is indicating we're going to get this big surge, because the demand isn't there. And now as the U.S. starts talking about and we start seeing additional cases, hospitalization utilization rates, what does that mean for the ICUs, as we talk about in segment 1 of the Econ show that came out on Thursday, you get an idea of kind of what we're talking about and why we think there's going to be additional pressure. Where we think we'll obviously get additions is pad 3. Pad 3, we think we're going to get a little bit of a bump in utilization rates, and that'll be that driver to the next level. But again, it's still going to be at historic lows as we look through the last let's say 30 years in a couple of graphics later. Implied demand had a nice bump. When we're looking at things overall, the biggest ones is obviously gasoline, distillate, jet fuel. Jet fuel had a nice increase. We have to talk about the jet fuel side, because that's interesting, and you have to think about how are airlines preparing, how are airports preparing for the increase in travel, because Thanksgiving is one of the biggest travel periods in the calendar year. But the way that they're talking about it is it's going to be expanded. Instead of it being really kind of focused within a 1 to 2 day period, they're expecting people to span it over about an 8-day period to minimize exposure. Kids, I don't know how, I know for my children alone, some people are getting extended holidays. People are coming home for Thanksgiving and then not going back for Christmas, and they're staying home the whole time. So people could essentially have an extended vacation, and you're starting to see that in terms of how some of these flights are planning out. So again, that's pulling through, making sure that jet fuel kerosene is sitting there, available for the planes. Distillate is an interesting one just because, again, we continue to see things move through the system. Getting, diesel continues to be consumed based on what we're seeing with trucking. Rail is coming into, really the peak of where we think some of the demand is going to be. And then obviously we have heating oil, which is mostly, which is distillate being moved through the system. Gasoline is going to be the one that has the most intricacies with it because, Gas Buddy had us down about 1.45%. Again, looking at the pump. Descartes had us down about 2% looking at miles driven. So again, this is a lot of things coming into play here. We had a hurricane that knocked things down, and you had to, again, backfill, because what this is showing is from the refiner to storage, and then storage to the actual rack. And then what Gas Buddy and Descartes is showing is what is happening at the consumer level. So sometimes you're going to get a recharge through the system, and then you'll see those dips, which is why we always look at that 4-week rolling average. Now, when we look at crude flow in floating storage, it's at zero. Again, we had the hurricane coming through. Ships had to move out of the way, make sure that they're not in harm's way. Again, it'll bounce, but just based on where Pad 3 is right now on utilization rates, we're not talking about anything meaningful. Like, we're going to stay well off of that 5-year average. It's going to be closer. We think it'll still remain, either just within the bottom of the cloud or just below. But we don't see anything really meaningful at this point, just because we do have onshore storage available, which means that you're going to be able to pull through a little bit quicker. And again, it's just, we're not seeing a lot of crude being sent to the U.S., and that comes down to how is the Middle East playing this? What do prices look like? Is there a way to kind of show that things are tightening, even though they might not be as tight as perceived, as we start to talk about OECD data, which is going to be in part 3. And, here you can see the imports into Pad 3, again, seasonally adjusted, over the last 5 years, we're at the low, we're making those new lows. And again, it's just going to come down to utilization rates, which, maintaining, even if we get to an 80%, if anything, we're just going to fall within the bottom of the cloud, but really nothing driving us back to those new highs, or at least the average over the last 5 years or so. So then when we, wrapping this one up, when we start talking about import data into Pad 2, we obviously it's lumpy, but here you can see that we're back to, a seasonally adjusted high when we're looking at, where things flow. We just think that, and as we said last week, we're just going to maintain above that 5-year average. We'll bounce back and forth just because there's timing delays. There's all types of means of, what are Pad 2 refiners doing? Is there going to be some pass through from Pad 2 into Pad 3? And that's why we think we're going to hold above the 5-year, but below that top of the range, and we're going to continue to see some of these this pull through. Now, when we look at refinery utilization rates, again, we had that shift down, and this is just looking at the last 30 years or so, and you can see that we just continue to make those lows. And there's really nothing telling us at this point, just because gasoline is moving back into those highs. Distillate is falling and getting into a normal range. And at this point, just given where spreads are, where pricing is, where the expectation of demand is coming from, there's really no need or rush to see some of this activity increase, where we actually had some permanent closures announced, which we'll go through in a bit more detail in the next segment when we start talking a little bit more about Europe and what does that mean going forward when we start looking at demand and how crude is going to flow through the system, and what do we expect for spreads, and we'll try to cover that because we covered it in part 1 of the Econ show, and then again we're going to cover it in part 3 of the EIA show.